This particular transaction that SOFI engaged in caused its stock to sell off over 15% in just one day. Now, although the stock has recovered since then, some investors still don't really understand what the heck happened and whether or not it poses any real danger to the stock even up to today. Anthony Noto has been on the record to tell us that this deal was done from a position of strength and can potentially help SOFI grow their business even further. But as always, potential is a dangerous word, so let's dive in. So the transaction that I'm actually talking about refers to their convertible note deal basically done back in March of this year. Now, for some context, SOFI priced their convertible note offering at 1.25%. So very simply put, what this means is that they actually borrowed money, $750 million to be exact, from institutions at a 1.25% interest rate per annum, and this loan will be over a duration of 5 years. Now, I think at the end of the day, the actual figure of this loan turned out to be around 862.5 million because the loan was actually oversubscribed, but I'm just going to be referring to this as the 750 million loan, which is their headline number, or the 2029 note. Okay, so this should be pretty straightforward. Basically what SOFI did was they borrowed money with a certain interest rate. So if you think about it, if you borrow $100 at a 1.25 interest per annum, it means that at the end of the first year, you end up paying $101.25 for the loan. So in SOFI's case, they basically did the same thing, but with $750 million. Now, there are actually a few moving parts to this transaction, and I think from the outside looking in, some of these transactions actually seem related, but how exactly they're related, especially about the parties involved, still remain quite unclear. So, at the end of the day, I just want to say I'm just this dude on the internet. I used to be a teacher, and so, for the way I invest, what I like to do is I try and simplify things down to a 5th, 6th grade level so that I strip out all the complexity and see how a particular course of action can actually fundamentally affect the business. And this allows me, at least in my opinion, to build a more robust investment thesis around the companies I invest in. Of course, for those of you who are in the finance sector and deep into investment banking and things like that, if you think I'm oversimplifying things or missing out certain key information, please feel free to clarify down in the comments below. But basically, in March of this year, SOFI did two things. They borrowed 750 million, which we talked about, at a low interest rate, and this is the 2029 convertible note. And at the same time, they also plan to issue about 61 million in stock to pay off an older batch of convertible note that was due in October of 2026. So this is basically a similar thing to what they are doing now with the 750 million, just that was done earlier. And this batch of convertible note will be due in 2026. And so if I refer to this, this will be referred to as the 2026 note. So while the first transaction, the 2029 note, was generally positive, I think the second transaction was seen as dilutive from a stock perspective, despite the fact that it could actually be positive from a business perspective. And whether or not that is true, we have to dive deeper to actually find out. So I'm going to take you through actually how I view this transaction and what impact it actually has on SOFI's business, even up to today, right? So we'll be talking about how the loan was structured, why the company engaged in this loan in the first place, why investors think that this is actually bad for the stock, and why investors might actually be overreacting. So if you take a look with me at the press release on 5th of March, let me just summarize for you what actually happened. SOFI borrowed $750 million by offering a convertible note to institutional investors at 1.25%. Now, a convertible note is basically a form of debt or loan that can be converted to shares under certain conditions. Companies actually like to use convertible notes because they usually have a lower interest rate compared to normal loans, especially because now we are in a pretty high rate environment, but with the caveat that further down the line they could be diluting shareholders. Now, these notes, right, will actually mature on 15th of March 2029, so that's a 5-year duration. And when exactly the note holders can convert their convertible notes to shares, right, depends on certain conditions, which will affect the time period that the conditions or the conversion, can take place. So to simplify this move, we will not focus on, as when exactly the conversion can take place, but that the conversion will eventually take place at whatever time period, and then how it will impact the business. And so what SOFI has done right now is that they actually have an agreement in place with the note holders that for every $1,000 that they lend to SOFI, SOFI will actually pay them back 105.89 shares. So that actually works out to about $9.54 per share. That is actually 30% more than the closing price of the day at $7.27, or you can actually call this 130% of $7.27. So upon settlement, SOFI will either have to pay off the debt using cash or in stock, and if they choose to actually pay off the debt in stock, then they will be based on this conversion price of $9.54. And this basically caused investors to worry about dilution, and I know that there are a lot of financial terms here that confuses people, so we are going to try and break this down into simpler terms for people to understand what actually happened with the business. And so if you're talking about the business, I think the first thing we have to understand is why SOFI decided to engage in this transaction. Firstly, they actually did it to redeem some preferred shares that they were paying a 12.5% dividend on. This dividend was set to increase later on in May of 2024, so they basically saved a bunch of money on interest. They also used this to restructure some higher interest debt and actually put a bunch of money towards protecting against dilution. Now, I'll actually expand on each of these points later on in the video, but all in all, it sounds like a pretty good deal, but it was the way that this 2029 note deal was structured along with the 2026 deal that actually spooked investors, and so let's dive in to see what actually happened. Now, I want to try and explain to us the first part of the convertible note deal, and before I explain how they protect shareholders against dilution. Now, let's say you run a coffee shop, right, and you realize that you actually need a loan. You go to your friend Abing and say that, hey, can you lend me $120,000 and I'll pay you, let's call it 1% interest, right, for the next 5 years, just to make it easier for calculation. And so Abing gives you this $120,000 and he expects to receive 1% per year, which is $1,200 per year for the next 5 years. So this part is pretty straightforward. Now, at the end of 5 years, Abing will eventually want to take back his $120,000, right? So at this point in time, then you can actually choose to pay him in cash or in stock. Now, cash is pretty straightforward. You just hand him the $120,000 and be done with it. However, under certain conditions, he can actually ask to be paid in stock. And this is down to this thing called the conversion price. Now, this term is something you actually need to remember because I'm going to use this term quite a lot going forward. Now, this conversion price will be set with Abing right at the start of the loan, and this conversion price is basically based on the trading price of my coffee shop today. So let's say, for instance, the coffee shop I'm own is basically trading at $38.50 per share. And so what I might tell Abing is that, hey, you know what? For every $1,000 that you lend me, I'm going to return you 20 shares. And what that means is that each share that I'm giving to Abing is actually worth $50, 130% of today's share price. Now, a very quick clarification, because at this point I know some people are a little bit confused by the math and the terminology behind it. I always tell my students this: when you see the word off, think of the word multiply. Okay, so you imagine this sentence: pay me 10% of $100. It's basically 10% times $100. You end up having to pay me $10. So similarly, when we say the conversion price is 130% of the trading price, it means 130% times $38.50, which will give you essentially $50. Okay, now back to the video. Therefore, the $120,000 that Abing lent me will basically entitle him to have about 2,400 shares worth $50 each. Now, like I said before, this $50 is the conversion price, and what that means is that when Abing converts his notes into shares, that is going to be the value of each of his shares. Now, but some other conditions must be met in order for the conversion to take place. Now, if you take a look at this paragraph over here, it's taken from SOFI's 8K. SOFI's condition for conversion is only if the last reported sale price per share of SOFI common stock exceeds 130% of the conversion price. Okay? Of the conversion price for a specific period and under certain liquidity conditions. Now, in English, this just means, that if my coffee shop is trading at $65, why $65? Because that is 130% of my conversion price, which is $50, for 30 days, then Abing can actually convert his notes into shares. I'm going to say that again. If my coffee shop is trading at $65, which is 130% of $50, for a total of 30 days, then Abing will be able to convert his notes into shares. And because each of his shares is worth $50, he can basically sell everything at $65 right now on the open market for a 30% profit. Now, the problem here is basically that there are other shareholders, and let's say, including you, there are a total of 10 shareholders in your coffee shop business. Each of you own about 2,000 shares of the company, making your total count to be about 20,000 shares. Now, If you, let's say, make 150,000 net profit each year through your business, your earnings per share would be about $7.50. And if you take the share price, $38.50, divided by $7.50, you get a PE ratio for your coffee shop of about 5.1 times. Now, so you imagine if Abeng actually comes in today with his 2,400 shares, your total share count will actually increase from 20,000 to 22,400. Now, what this means is that your earnings per share will be lowered to $6.70. And if you use the same PE ratio and apply it to the EPS, your share price will be closer to about $34.30 instead of $38.50. And that is what causes shareholders to sell off in the event of a dilution, because you are essentially sharing your profits with more people, so everybody kind of get less of the pie. Now, of course, unless you can grow profits faster than dilution, but that's another story for another video. However, for the dilution to take place, SOFI's price must have gone up by about 69% or more and stayed there for over 30 days. So if you ask me, I think about it this way. At the end of the day, you are happy to get the loan to expand your business. Abeng is also happy because he can collect interest and then either receive his capital back or receive a bunch of shares that he can sell for a 30% profit, right? On top of that, the 10 shareholders are happy because they grew their investment by about 70%. And of course, at the end of the day, the problem is the dilution takes place. So actually, who does the dilution really affect, right? It's not the shareholders that were in the business early on. It's actually the newer shareholders, the ones that actually bought the shares closer to the date of the dilution. But of course, that's not the end of the story, because SOFI actually knows that shareholders don't like to be diluted, and of course, they actually took some precautions. Now, they actually softened the blow by using this thing called cap calls, and this is where it can get a little bit confusing. Now, you can see here, SOFI actually planned to use 78 million of the 750 million to buy some cap calls. I think at the end of the day, you can actually do the calculation, and I'll show you later on that the final number is actually closer to $90 million. Now, before I go even further, right, I just want to preface this section by saying that, to understand this, you need to have some basic understanding of options. I can't go into every single detail regarding the options terminology, otherwise this video will be way too long. I'm just going to be focusing on the effects that the cap calls have in protecting shareholders against dilution. Now, a cap call is basically a complex form of a call option, right? A call option is a derivative where you pay a small amount of money today for the right to buy a stock at a predetermined price and at or before a predetermined date. So, if the stock price goes up, basically so does your profits. And in a way, a call option is limitless, right? Because theoretically, the stock price can keep going higher and higher and higher. Now, the only difference with a cap call is that your profits, as the name suggests, will be kept at a certain level. So in SOFI's case, this cap is actually $14.54. How do they get this number? This is actually 100% of the closing price on the day that the deal was done. Of course, if you have any question regarding options, do remember to hit the like and subscribe button as you are writing down your comment below with your questions, and I will slowly get back to each and every one of you. Thank you for your time, and back to the video. Now, so the important thing is, how does this actually protect shareholders against dilution? Now, you imagine the situation with the coffee shop that I was talking about. Abeng actually is entitled to 2,400 shares, and so what I'm going to do is I'm going to spend 10% of the loan, which is about $12,000, to buy 24 cap calls. Now, these cap calls have a strike price of $50, which is the conversion price, and a cap, which means the maximum profit is $77, which is 100% of $38.50. So basically, I'm just using SOFI's numbers, right? So let's say my coffee shop goes up to $65 and Abeng can, actually convert his notes into shares at this point in time. The profit of the cap calls would actually be $36,000. Now, how did we get $36,000, right? Basically, you take the difference between the strike price and the current price of the shares, so 65 minus $50, and you multiply it by the total number of shares, which is 2,400. So this 36,000 actually helps to offset some of the dilution, not all, but some of the dilution. Now, you imagine with a conversion price of $50, which means I need to pass him shares worth $50, right? This $36,000 can actually buy me 720 shares that are worth $50, which means I only need to issue an additional 1,680 shares to make up the 2,400 shares to be delivered to Abeng. And so this basically lowers the dilution from 12% to only 8.4%. Now, if you consider with me another scenario, if the share price continues to appreciate and reach the cap level of $77, what this actually means is that your actual profit will be $64,800, and that would eventually help you pay for about 1,296 shares, which means that you only need a further 1,104 shares in order to make up the 2,400 shares for Abeng. Hence, in this scenario, right, the dilution will actually be only 5.5%, right? Because you only originated 1,104 shares out of the original, 20,000 shares. So 1,104 divided by 20,000, you get 5.5%. So therefore, shareholders don't actually need to be too worried about dilution in this scenario, because even if you have a 5 to 8% dilution, that's not too big a deal because the stock that you're holding actually doubled in price. And so similarly, I guess in SOFI's case, depending on your cost average, right? Depending on where you're holding SOFI shares, when SOFI is at $14.50, some of you might be double at this point in time. Some of you may be up 50, 60%. And if you're up that much, in terms of your shares that you're holding, having a couple percent dilution, to me at least, doesn't seem too big a deal. I think, like I said before, it's only those with a brand new position above the conversion price that will be hit the most during that point in time. So in plain English, SOFI basically borrowed a total of $862.5 million with a 1.25% interest rate using a financial instrument known as a convertible note. So this means they will pay back note holders eventually either in cash or in stock by March of 2029. Now, what happened is that investors were worried that this deal potentially causes dilution, and we have covered, yes, it actually does cause dilution, but at the end of the day, for the dilution to happen, the stock price must go up by, at least around 70% for that to happen. And so if that is the case, it's actually the shareholders that actually enter into the stock at a later point in time that will be hit, rather than people who are currently holding the stock. So I guess SOFI, also knowing that investors will be kind of worried about the potential dilution, they actually use another financial instrument known as the cap call to protect investors against the effects of dilutions. Now, on top of all of that, they actually also use this amount of money that they borrowed to pay down other debt, to restructure their debt so that they are paying lesser interest. And so that's all you actually need to know regarding the 2029 convertible note deal. I hope this is understandable so far. But to really understand what spooked investors and how all of this is tied together, you have to understand how they dealt with the 2026 convertible note. Now, earlier on in this video, I actually showed you this press release where SOFI planned to issue about 61 million shares to offset 600 million of debt from the 2026 note. However, because the price at which the notes were redeemed are taken from an average of over a 3-week period, right? The average price of SOFI during the time was about $7.29. So SOFI ended up having to issue 72.6 million shares instead of the 61 million shares reported, and this was definitely more dilution than expected. But if you did the math on it, you actually realize that they only paid about $529 million to clear about $600 million in debt. Now, this was largely because, this current batch of convertible note due in 2026 had a conversion price of slightly above $22, and so the holders of these notes probably took the loss so that they can redeploy the cash right now. Right? This convertible note basically pays a pretty low interest, about below 0.5%. So right now, these holders can actually receive the cash back, although they take it at a loss, but they can redeploy the cash for a risk-free 4 to 5% at the time of writing. But it is this dilution that makes investors worried that the same thing could eventually happen with the 2029 note. If you take a look with me at the numbers, the 2026 note were worth about $1.1 billion. Now, this $1.1 billion had a conversion price of $22.41, which would make it worth about 49 million shares if they were all redeemed. Now, these 49 million shares, right, are actually included in the diluted share count that you see over here. So whenever SOFI reports their diluted EPS and things like that, all these 49 million shares are already accounted for. And this is where we have a problem, because they only accounted for the 49 million shares. But in the press release that I just showed you, it basically shows SOFI issuing 72.6 million shares instead. This is way more than whatever they have accounted for. So if you take 72.6 million minus whatever they accounted for, 49 million, you end up having an additional 23.6 million shares to be added to the diluted share count. But that is not all. On top of that, don't actually forget this 72.6 million shares actually only paid off 600 million of the $1.1 billion debt. So there is still about 500 million outstanding. And if you assume the original conversion price of about $22.41, that is another 22.3 million shares to be added that haven't been accounted for. You put these two numbers together and you get an additional dilution of 45.8 million shares. Now this number of course will be added to the diluted share count, which you can see increase over here over this last quarter. But how does this actually tie in with the 2029 note? Now in the 2029 note, you actually see that SOFI borrowed a total of 862 million shares, and with a conversion price of $9.54, that would mean around 90.5 million shares to be converted by the note holders eventually. You add that to the 45.9 million shares that they did not account for, you have to add a total of about 136.3 million share dilution over the next 5 years. Now, why did SOFI do this? Why are they seemingly okay with diluting shareholders? You see, from the initial disclosure, right, we did find out that each cap call is worth about $100. So to cover the extra 90.5 million shares in the 2029 note deal, they will end up having to use about 90.5 million from the loan amount to buy back the cap calls. And after you net off all the other fees and charges, SOFI have about 750 million to put into their business. And so this is why Anthony Noto said this 750 million can be used to make SOFI's business stronger, and that is why they are okay with the dilution. So how exactly did they use this 750 million? The first thing they did was to redeem their 12.5% preferred shares. This actually cost them about 320 million to redeem, you can see over here, and that actually saved them $40 million per year. Additionally, right, this 40 million was set to increase to 50 million by May of 2024. And once that increase happened, they were not able to redeem this share anymore for the next 5 years. So they had to do it at this point in time. So this means, after you take the 750 million minus 320 million, SOFI would have about $430 million left. Now, using this excess money, SOFI can actually also restructure their debt. So as you can see, from December of 2023 all the way to the second quarter of 2024, they lowered their outstanding debt, which actually in turn lowers their interest expense. Now, in fact, on an interview with CNBC, Anthony Noto basically mentioned that this convertible note deal, they used it to pay off two high interest debts. So one being the preferred shares, which I was mentioning earlier, and they actually have another high interest debt of around 500 million that they were paying 7% on, and paying off these two debt means more money flowing down to the bottom line. Now they estimate that their cost savings from these two debt will be around about 40 to 65 million, and for a company generating about $100 million in net profit per year, that makes a huge difference to their bottom line. Now, and finally, this actually helps SOFI increase their capital ratios. It basically provides them with a safety buffer in case of a recession, and at the same time increases their ability to lend. Now, SOFI actually guided for capital ratios to be above 14% for the whole year of 2024, which is why they also guided for a lower lending revenue. But as you can see, as of December of 2023, their capital ratios increased to 15.3%. And they actually told us that, if this 2029 convertible note deal was actually concluded in the fourth quarter of 2023, their capital ratios would have been up to around 17.3%, which puts them in a very, very safe position and essentially kills off the bear thesis for SOFI being capital constrained. When SOFI actually issued the 72.6 million shares and paid off the $600 million in debt, right, they essentially freed up their capital. Of course, not all of the $600 million can be used because you have to net off the fees and also at the same time account for the $90 million that they actually used to buy the cap calls for the 2029 note. But all in all, that leaves you with a ballpark of around 450 to 500 million in capital to play around with. And if you assume the 15.3% capital ratio currently, that will work out to be about 2.9 to 3.3 billion in assets that they could add. So the dilution basically helped to free up capital to grow SOFI's business. But if you thought that was all and this is the end of the video, you are wrong, because I saved the best for last, and those who did not watch to the end might not actually hear this. Now, I've been talking about dilution so far, but Anthony Noto on CNBC actually told us that, hey, you know what, this is actually a net neutral move. That means that there is no dilution. But obviously, we just saw SOFI added, around 90 million shares for the 2029 convertible note and an additional 45 million shares, which they did not account for in the 2026 note. And this is basically a 13 to 14% dilution. So how is this exactly net neutral? Now, you see, on a net income basis, what Anthony Noto explains is that the $40 to $65 million saved in interest expense actually flows down to net income. Hence, the dilution is actually offset by a higher net income. But it's not just that. A lot of people still judge SOFI as a bank, and I disagree with them. But if you take a look at their tangible book value as you would a bank, this actually stands at about $3.4 billion in December of 2023 and grew to over $4 billion at the end of the first quarter of 2024. That is about a 17% increase in tangible book value. And so basically overall, it puts them in better standing. Now, in English, what this actually means is that, SOFI did all of those things, like I mentioned above, to improve their business without actually causing much dilution, because at the end of the day, although they did increase their share count, which is dilutive in nature, they also increased the value of each share by a similar amount. And so, like I said, at the end of the day, all in all, right, all of this is only a positive if the company can execute. And the thing is, SOFI has been doing just that, which is why in this video over here, I talk about how estimates by analysts are way too low. And in this video over here, which is going to be up on Thursday, I will talk about my expectations for their upcoming earnings, and I'll see you in the next one.